What's up, everyone? Let's talk about ETF. Why you should buy ETF if you're a beginner and you're starting your investment. Also, 3 ETF you should buy in your 20s that you should hold forever. Now, in this video, I'm going to give you the key benefits for why beginners should buy ETFs, a comparison from stocks to ETF, and 3 ETFs that you should hold forever and show you their charts. And I'm also gonna show you how to open a brokerage account through Fidelity so that you can have a basic video how to invest. So at the end of the day, investment is a risk. You should not investments are risk, and you should not invest anything you cannot lose. Now let's get into this video. So ETF, exchange traded funds.
Got some money saved up. I think I'm going to get an ETF. Cool. Do you know how they work? No, but I've heard my friends talk about them. Well, before you decide, here's what I know. ETF stands for Exchange Traded Funds, and instead of investing in one stock, it's like a curated basket of stocks or bonds that you invest in all at once.
Who are you talking to?
In Canada, you have to be the age of majority to get an ETF, so in your case, you'll have to get your parents to help you. There's also lots of ETFs out there, with lots coming out daily.
Are often considered the best way for beginners to start investing because they offer a diversified, low cost, and easy to manage alternative from picking individual stock. By purchasing just one share of ETF, a beginner can gain exposure to hundreds or even thousands of different companies at once. Benefits for beginners first, and at the end of the day, remember, this is for beginners, and if you are going to do your due diligence, it's different, but I'm talking about someone who's just entering and want to learn how to invest. ETF is a great way to start investing. Now, the first key benefit is instant diversification. If you didn't, has a broad market in there. So it has a bunch of different companies. You can buy all different type of ETFs. One for real estate, one for S&P 500, one for bonds, one for dividend. So ETF is very diverse and you can buy all different type of ones. So instant diversification is the first key benefit. Instead of risking your savings on a single company that might fail, an ETF spreads your money across many assets. For example, the S&P 500 ETF provides a small stake in the top 500 largest U.S. companies simultaneously. One stock, you own all. The second key takeaway for beginners why is low cost. Most ETFs are passive, meaning they simply track the market index rather than paying an expensive human to pick your stock. This result has a much lower fees. So expense ratio is very low compared to a mutual fund. Yes, some mutual funds do get a better return, but it also has a higher expense ratio, and ETFs has one of the lowest ones out there. Number 3 key benefit is ease of access. You can buy and sell ETF on a major stock exchange, just like individual stocks, through a standard brokerage account and app. Many brokerages now offer commission-free trading for ETF. And at the end of the video, I'll show you how to open one. So stay tuned to that. And we're going to use Fidelity to open it. And I'm going to show you to their website. Now, the fourth takeaway on the key benefit for beginner is tax efficiency. Due to their unique internal structure, ETF generally trigger fewer capital gain taxes for investor than mutual funds do, meaning you get to keep more of your money. Way on it is no high minimum. Unlike some mutual funds require you to have thousands of dollars to start, meaning ETF you can purchase at a cost of a single share or even as little as $1 if your brokers offer fractional share. So those are the key benefits for beginners. Now, let's talk about why ETFs are popular or popular ETF type for new beginners. So some of the very popular ones are total market index ETF. These aim for replicate the performance of the entire stock market, like the S&P 500, NASDAQ 100 are the most common ones to start. The second popular ones is bond ETF. These hold very type of bonds, provide many stable regular income compared to stocks. Yes, you can buy bonds ETF. I generally don't buy bonds because I'm willing to take the risk at a longer time. But at the end of the day, this is for someone age 20. He should buy bonds, but this is someone age 20 that wants to try to grow. And the third one is international ETF. These allows you to easily invest company outside your home country, further diversify your portfolio. So those are some of the popular ETF people invest in. Now, let's do a comparison at a glance. I'm going to put on the screen so you can see it. So individual stocks is risk level is very high, where mutual fund has low diversity and ETFs has low diversity. So the risk level is low due to diversity in mutual fund and ETF. Now, individual stocks. Now, the cost for individual stock, zero management fee. It's great, but it takes a lot of due diligence. Where mutual fund, you have higher management fees, and ETFs have low management fee. I prefer not paying a management fee, but beginners, you should worry about this. You should just pay a management fee so you don't lose money on picking hype stocks or diamond hands or whatever you want to do, because this happened to me. I lost a bunch of money doing this, but at the end of the day, let's keep going. Trading. Individual stocks allow you to trade throughout the day, and mutual fund only allows you once per day, and ETF is throughout the day. Now, here's the other feature is ease for beginner. Is individual stock is hard because it requires a lot of research without screwing up or losing money. Mutual funds is easy and it's managed by someone else. And ETF is easiest because it's well diversified and flexible. Now, how do you start? Let's go to how do you start. Remember, at the end of the video, I'm going to tell you how, but you open a brokerage account, use a platform like Fidelity, Vanguard, Charles Schwab, or Robinhood. You search broad-based ETF, and I'll show you all this on there, and use dollar cost average. You just automatically invest in it, and you're done. 3 ETFs you should hold forever. I'm going to go over them before, and I'll put it on the screen, each one, but let's go over them first. So there's 3 of them I recommend you buy and hold forever, just because it gives you a better look on the outcome. And the first one is Vanguard Total Stock Market ETF. So the first one I recommend is VOO. Now, this fund seeks and tracks the benchmark for the S&P 500 and Funds Employee Index Invest approach. So this one's a very good one. It has a very low expense ratio of 0.03%. It pays a dividend percentage of 1.11%, and it's pretty well diverse. And they have pretty good companies like Nvidia, Apple, Microsoft, Amazon, Broadcom, Alphabet, Meta, and Tesla. So it has a pretty good holding. So remember, it has the top 500 company in there, and I recommend it. Now, what percentage you want is based on what you want. That we've seen the stock, we know the expense ratio, and we know what's in there. Why buy in your 20s the S&P 500 or VOO? Well, the big reason why is because it's focused on VOO tracking and the S&P 500 index. So you get the largest 500 company in the U.S., and unless the U.S. economy drops or loses money, you're fine. It's going to be growing. Now, why buying in your 20s? S&P strongly tracks the history of long-term growth, making it a cornerstone of wealth building over decades. It offers instant diversification across major sectors in the U.S. economy. And VOO total returns in the past 12 months is 14.25%, and it currently priced at $626 as of December 12th. So it's a pretty good one to have. Now the next one I recommend is QQQ. Why? Because This fund seeks invest results, generally compound price yield performance of the NASDAQ 100 index, and it gives you a good variety, and it has an expense ratio of 0.20%, and it pays a dividend of 0.45%. It's a pretty good stock to have. And the holding is, again, NVIDIA, Apple, Microsoft, AVGO, Tesla, Meta. So it has a pretty good holding. I would recommend you diversify, put whatever percentage you want in each one because the numbers differ per person, but it's another good one to have. And the reason why I recommend this one is QQQ tracks the NASDAQ 100 index, which is heavily weighted towards growing orientation in large cap technology companies. And I think it's going to be a big tech boom. So it's a good one to have. Why buy it in your 20s? Is investors in their 20s can afford to take more risk in this pursuit for higher return. Tech companies drive innovation and a significant growth. So it outperformed VOO. The growth competition is better. So at the end of the day, I think it's a good one to have and a little bit more risky, but in your 20s, you can take the risk for the growth. And a 15.66% return last year. And the last 3 years, it had 123% return. In 5 years, it had 103%. So it had phenomenal growth in the last 5 years. So you get a great return, especially if you can get a 15% return every year. So it's a very good one to have. Now, the last SCHD. Yes, it's kind of been looking very funky and hasn't been growing very well lately, but it is a very good one still have a very low expense ratio of 0.06%, and this fund seeks the total return of the Dow Jones US Dividend 100 Index, and it has a pretty good dividend yield of 3.76. And the reason why I recommend this one is because it's diversifying your portfolio. It has different stocks besides the ones like Amazon and Tesla and the bigger tech companies. And the thing about it, if you buy ETF, you want to diversify. And this is the reason why I tell you to buy this one. Maybe the returns aren't as good as the other ones right now, but the whole point of you buying an ETF is to diversify. And you don't want to buy one that is in the same stock as everyone else. And yes, it hasn't had a great return last few years, but I think it's recovering and it will end up doing pretty well next few years. And last month it grew 1.62%. It grew in the year to date 1.32%. And 5 years it grew 29.95%. And I don't think this stock is done for. I think it's a very good one, especially if you are building it to diversify. And it pays a 3.78% dividend yield. And so why do I recommend SCHD, not SCHG? Well, mainly it's because the diversification part, but SCHG focus on dividend paying U.S. companies based on the fundamental strength and consistent dividend payment. So why should you buy it in your 20s? Well, while the primary focus growth, additional dividend ETFs introduce a layer of stability and passive income. So this income can be reinvested to buy more share and supercharge compound interest over time. And that's one of the reasons why I recommend it. So let's get into the part of how to open a brokerage account. It's very simple. You go on here, you press open account, counting on which one you want to do. If you're doing a retirement account, you just press open account, and it's that easy. Now, and this is how easy it is to find a ETF that you want to buy. You just go down to their ETF and choose what you want to get. So get started, find an ETF. You're going to have to log in, and that's it. You can just type it in what you want and they can help you find it. And you can get easy by starting by clicking and looking right here. So you can look up QQQ, right? This is how easy it is to find stocks, and you can see how they perform, what they are holding. And if you log in, they can tell you more information. And you also get data like analysis, and they Morningstar gives this one a 5-star. So this is why I have Fidelity. It does have a better search engine for me, and I've been using it for a year. And that's it. That's how easy it is to open a brokerage account, look up stocks that you want, and you can do all types of stuff when you log in. You can go to comparison. But that's all I got for you. Those are the 3 ETF I recommend buy in the 20s, and also why beginners should buy ETF and not stocks. Like, subscribe to my video, and that's all I got for you.